Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, July 8th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not investment advice. I am not a registered financial advisor. I cannot give individual investment advice. This is for informational purposes only. Please do your own due diligence on any ideas that are provided. It's your money, it's your responsibility. One housekeeping issue, just to remind people, if you are one of the people that used to like to listen to the weekly market update via podcast, I've migrated over to Podbean. I'll put a link in the show notes of this video that will take you there. I had some issues when Anchor podcasting was taken over by Spotify. It's not really working very well, so I just migrated the podcasts over to Podbean, and I will use that tool. Obviously, you're going to have to download another app, I guess, to listen to it, from what I understand, but that seems to work. That venue seems to work a little bit better than in the past. I think that I will be able to eventually distribute via some of the other platforms like Apple and stuff like that, and Spotify through Podbean, but I just need time to look at it and work on it. Okay, let's get into this week's news and slides. So we had a lot of information that I was anticipating this week. The first thing to go over is U.S. Manufacturing Purchasing Managers Index had dropped again. The June Manufacturing PMI registered 46%. It's a 0.9 percentage point lower than the 46.9% recorded in May. Regarding the overall economy, this figure indicates a 7th month of contraction after a 30-month period of expansion. The new orders index remained in contraction territory at 45.6, and the production index reading of 46.7 is a 4.4% point decrease. The prices index registered a 41.8, down 2.4%. The backlog of orders registered 38.7, which is 1.2 percentage points higher, and the employment index dropped into contraction, registering 48.1, down 3.3 percentage points from May's reading of 51.4. So again, what I've talked about before, the ISM Purchasing Managers Index comes out every month. The readings above 50 indicate expansion, and readings below 50 indicate contraction. So as we've said before, it's obvious we're in a manufacturing recession in the United States, not only in the US, but around the world. That's why you're seeing weakness in commodities. The world, manufacturing is slowing down. So we are in a manufacturing recession for sure now. With respect to the United States, manufacturing isn't that really large of a portion of the economy. It's only around 12 to 15%, something in that range. But obviously, it does have an effect, right? So there is a positive here. The prices paid, the prices index is falling too. So and if you go to the website and look at the report of I'll put a link to it in the show notes, but you will see when they do these are surveys that they do of purchasing managers in different manufacturing industries. And so you'll see some of the comments they get back. You'll notice that, some of them are positive, most of them are negative, but you will also notice that they are seeing prices for raw materials and supplies going down, which is positive, right? That's what we want to see, is inflation decline. So that's a positive. It's not positive that employment is dropping in manufacturing. Obviously, if your business is slowing down, like we said before, this is the 6th month of decline, or 7th month of contraction in manufacturing PMIs. And so that would be kind of the range, right? If you're running a business and you're slowing down, it's like, okay, we got to start doing layoffs. Business isn't turning. We're in a recession. Orders are slowing down. Backlog is receding. We're catching up on the orders. no new businesses coming in, or lower levels of new businesses coming in. Therefore, we need to cut costs. And so you're starting to see that now. So we'll continue watching this. This is one of the major things that we look at for nowcasting in the hope cycle. And this is obviously we're in recession in manufacturing. We also came out information that the German manufacturing is contracting. Germany's manufacturing sector contracted at the fastest rate in more than 3 years in June, with both output and new orders falling, a survey showed on Monday. The final Purchasing Managers Index for manufacturing, which accounts for about a fifth of Germany's economy. So you see manufacturing in Germany is a higher percentage of the economy than it is in the US, fell to 40.6 from 43.2. This is the fifth consecutive month of decline. This is pretty significant. That's well under the 50 line for expansion. Manufacturing PMI has been below the 50 level that separates growth from contraction since July 2022. So that's a year. German manufacturing firms reported deeper cuts to production levels at the end of the second quarter in response to a sustained weakening of demand. So that's another economic block. Europe, China also has PMIs below 50. So we have a global manufacturing recession. I don't think that can be denied. And again, that's why you're going to see prices or disinflation in commodities. But again, this is just, I believe, the beginning of this. As what we're seeing more and more, though, is as this slows down, you're going to see prices, continue to decline in some areas that obviously the inputs that go into manufacturing. The interesting thing here, the other fact that we look at, one of the things we've talked about in this view of the economy is employment. Employment being the last lagging indicator as the rest of the economy, as tightening liquidity and higher rates make their way through the economy with a lag effect. The last thing that normally is impacted is employment. And we saw some stunning news, in my opinion, this week, like the ADP report. ADP does processing of payrolls, so they get a lot of real-time information, I think, about what's really going on with U.S. employment. And so the June report came out this week, and it says ADP report showed private employers added 497,000 jobs in June. This was really pretty good because the previous month it was like 275,000 or something like that. It had been around that 280,000 level for a few months, and also we had this big jump. And then I had some people, I saw some people comment, well, this is an anomaly. I would disregard this. I mean, I don't disregard. I put the stuff in my tracking, and something's happening here. Well, as we thought was happening, we know manufacturing slowing down. We know housing's down year over year, even though there is pent-up demand, but interest rates, with mortgages are what, 7.5%, something like that. So that's kind of a little bit slow, even with the demographic pressure of demographics behind it. But service sector jobs, people are out spending money. I mean, I have the view that this is the last hurrah of the consumer. We're seeing credit card delinquencies increase. We're seeing people basically just, the last throw of the dice. But if jobs are there, people are going to spend money. I heard one person say one time, they're a wealthy person, and if they get they said that if somebody put $1 million in their bank account, it really wouldn't change their lifestyle or spending because they already are wealthy and have all the things they want, and they do what they want because they're not constrained by any budget. They go out to eat, they do what they want. Conversely, the average middle class person, if you give them an extra, or lower middle class or working person, if you give them another $100 a week, I mean, they're going to spend it, right? They're going to take their wife out to dinner. They're going to take their kids, out somewhere to do something, that's what they're going to do. As soon as it goes in their pocket, they're going to spend it. So that's kind of the difference. So as long as jobs are plentiful and people feel confident in their job prospects, or they're able to get jobs, then they're going to spend money, right? That's the U.S. economy is 70% consumer spending focused. And so what it says here is in the report, again, you can read the reports. I read through these things. I also take the headline number. You want to see what's really happening. And one of the things they pointed out was in the report, which I'll put a link to this also, you can read it. You should be tracking these things anyways. I mean, if you're interested in this, but we'll do it for you here at Actionable Intelligence. It says job creation surged in June, led by consumer-facing services. So this makes sense, right? This kind of plays in what we've been talking about. People are going to spend as long as they have money. And remember, there's still a lot of stimulus. There's still a lot lagging effect of all the money that was put into the economy with fiscal spending that happened. People had saved a lot of money and they're out spending it now, right? So there's still a lot of that money sloshing around from the pandemic response that the fiscal response that the government did, which was, trillions of dollars. Said job creation surged in June, led by consumer-facing services. Leisure and hospitality, trade and transportation, and education and health services showed strong gains. Still, the market was fragmented, with manufacturing, information, and finance showing declines. This is what we've talked about. We have, currently a manufacturing recession. We have maybe recessions in finance. We know there's been a lot of high-tech layoffs. But, there's plenty of jobs if you want to be a server at a restaurant, or if you want to work at an amusement park, or, lawn service. These are not, in my view, jobs that are super high paying, that are going to lead, the economy forward. But that's my opinion. Again, with this surge in spending at restaurants, hospitality, you're going to see in a later slide, air travel is booming. There's a lot of this, like I said, I think it's, people are, if they have money, they're going to spend it. So that's what they're doing. This is the quote from the ADP chief economist. She said that her view was consumer-facing service industries had a strong June, aligning to push job creation higher than expected. But wage growth continues to ebb in these same industries, and hiring likely is cresting after a late cycle surge. So I don't know. Obviously, we can't tell the future. Again, we're just looking at the data as it comes. We have a thesis, and we want to see if the data is aligning. But again, as long as employment holds in, consumer spending is going to hold in, and the economy is not going to, overall go into recession. We could very likely have a manufacturing recession, but not have a consumer-led recession in services. So we'll have to see how this plays out. But so far, this is how, I still have the view that this is a Wile E. Coyote economy. You remember the old Roadrunner cartoons when the coyote was chasing the Roadrunner. What happened at least once during each cartoon, where he'd be chasing the Roadrunner and the Roadrunner would slam the brakes on, the coyote would go off a cliff, and he would be looking at the camera with a look of shock in his eyes, and his feet would keep going. Then he would realize that he was not on solid ground and fall. And there was a time gap that took. So that's kind of where I'm at on this. We don't really know, but we have other things with, like I said, the lag effect of rates making their way through the economy, tightening lending standards by banks, these liquidity issues eventually, QT continues. And again, this is, has to be offset by the lingering effects of the stimulus and things like that. So again, employment is always the last leg of the stool. But that's where I'm holding in. But again, things can, how long could this be? Later into 2023, early 2024? Who knows? Could we just have a manufacturing recession? Could we actually get a soft landing? Anything's possible. Again, I'm not going to forecast this because it's impossible to know. All we can look at is the data and look at past history to see when we see certain information come through and what has transpired in the past. When you have leading economic indicators down for 14 months in a row, you have we've went through the litany. So again, we got to give it to the economic bulls. Employment, as long as employment holds in, things are probably not going to get too bad. And here we are. Service sector PMI came out this week. Manufacturing comes out first, and then service the following week or later in the week. But it said business activity index at 59.2%, new orders for services at 55.5. These are both expansionary. Employment at 53.1. This verifies and goes to further bolster the view of employment doing well. Supplier deliveries index at 47.6. Said economic activity in the services sector expanded in June for the 6th consecutive month as the services PMI registered 53.9%. The sector has grown in 36 of the last 37 months, with the lone contraction in December of last year. So again, services, the service sector of the U.S. economy is approximately 70% of the economy. This is everything that's important relating to service sector is well above 50, which is the threshold for expansion. So you have to give it to them. Things are booming in the largest portion of the economy. So this is going to continue until people run out of money. And when that is, I don't know, but we'll see. If the contraction in liquidity, the higher lending standards, banks not making the same amount of loans in the past, we'll just have to see how this goes. And I'm waiting again for this lag effect of these rates and this tightening to slowly but surely make their way through the economy as they have in the past. Again, we were probably at about 1.5%, something like that, in the Fed funds this time last year. Because the rate increase was so fast, it's going to the fastest increase probably in 40 years in rate raising. And the fact that the Fed has such a large balance sheet, they're slowly but surely working that liquidity off, running off those, and doing that QT. We're seeing this take longer. I think these things always take longer than people anticipate, just like everything we've talked about, even in investments and things like that. However, the trend is clear. If you look at previous history, at some point, again, the coyote's legs stop moving and you fall. So I thought this was interesting. This was a chart that was on Twitter. I don't think it's actionable, but I just thought it was interesting. And this shows cell phone activity in downtown. They put the clip up here. Cell phone activity in downtown San Francisco is currently 29% of pre-pandemic levels. That means cell phone traffic in downtown San Francisco is 70% less than it was before the pandemic. And they have San Francisco, you see here, they have a lot of major cities here. And what you're noticing is you're not having a lot of cell phone traffic in these downtowns. Why is that? Well, people were sent home during the pandemic, and a lot of people are not coming back to work. Now you're seeing like Cleveland, St. Louis, Minneapolis, Portland, Indianapolis, New Orleans. All these are all major cities. Seattle, they're all below. I mean, until you get to like the 50% level, Chicago, Detroit, Austin, even Boston, Oakland, a lot of these cities are well below 50% of their previous cell phone traffic. So people are not coming back to the downtown. Okay. The only places you're seeing growth is places like El Paso, Fresno, Bakersfield, and Salt Lake City. So I'm not establishing a trend here. I'm not suggesting this is actionable. I do think it's curious because if people are not coming back downtown, we've already talked about commercial real estate probably being another big bomb that's going to go off at some point. We already have shown in San Francisco, for example, buildings that have, people have just turned the keys in on and walked away. A couple of hotels, major office buildings. And again, the real estate prices are set at the margin based on previous comps. And so if you are coming up for a lease, or you want to have a new business, or you're looking for office space, and you see that, rates are down, you've seen all this stuff, then you're gonna have a lot of leverage as a buyer or lease, or somebody that's leasing office space. And then when you do that, that's the comp for everybody else, right? People are going to say, well, why would I pay more than this guy paid if you're not going to give me a deal? And then what will happen is, because people become desperate just for cash flow, this happens in any kind of industry, people get desperate to service their debt. And so they're willing just to get something coming in. And so when that happens, if those cash flows that are coming in that are reduced are insufficient to service the debt, well, then you can see where the problem starts to develop. Again, these things take time to develop. But I thought this was interesting. This isn't just one or two cities. It's like all major cities. A lot of your major cities here are not, we see this, well, people are returning to the office, but are they? This was as of April, so it's a little bit dated. I would like to see, this is from the University of Toronto School of Cities. I don't know, it was on Twitter. I just thought it was an interesting anecdotal piece of information. So this is a guy I like to follow on Twitter. He also does podcasts. Very interesting guy. It's a guy that owns car dealerships. He talks a lot about what's going on in the industry. And one of the things I've been shocked by, this consumer, late stage economic, most people, I was just talking to my wife about this the other day. We were sitting and talking, not that she's interested in me blabbering about economics, but I reminded her, like, when we bought our last car, we basically, I pay cash for my car, so I'm always negotiating for the cash price. And I was reminding her, when you're sitting in your little cubicle waiting to consummate the deal, you can hear people in other cubicles, and the salesman always talking to the people about, not about the car price, it's the monthly payment. They always are going to try to rig things, or not rig it, but situate the deal such that you feel comfortable as the consumer. Well, not you, but most people, feel comfortable with the monthly payment. As long as I can make the monthly payment, I'm good. They don't look at the price. They don't look at the terms of the loan. They don't look at the trade-in value. If they have a trade-in that's paid for, which many people don't, they go in there with negative equity and they just roll the thing over into the next loan, a lot of stuff. But what I like about this was, you've heard these horror stories, and I've repeated them on this channel, where people have like $600, $700, $800 a month car payments, over $1,000 a month car payments. This is crazy. And for like 7 years. And so this tweet that he put out this week says, new month, new record. And he has this face, like, oh my goodness face emoji. $1,000 monthly payments aren't going anywhere. Nearly 1 in 5 consumers who finance, that's 20%, who financed a new vehicle in Q2 2023 committed to a monthly payment of $1,000 or more, an all-time high. Absolutely wild. He says the data is from Edmunds. This will not end well. Okay, as long as you have money coming in, again, this is what I talk about. The economy is like, is this an indication of a strong economy where 20% of the people buying vehicles have $1,000 a month car payment? First of all, vehicle prices are too high. People don't know how to, most people, how are you going to build wealth if you have $1,000 a month car payment? That's like a rent house you could get. That's money that you could just be pumping into like dividend paying stocks, and then put that into that's like, I challenge people, like, get yourself I go back to that John Goodman 2-minute speech in that movie The Gambler with Marky Mark. What happens when a guy gets ahead, when you get 2 million ahead or something like that, what to do. I'm not going to repeat it because it's kind of not YouTube friendly, but you should watch that video. It's kind of interesting. It's not that hard to figure out how to do this. And I was listening to a podcast the other day about the guy, or one of the people that did the book, The Millionaire Next Door. I also saw a clip by Dave Ramsey. A lot of people that you see flashing wealth, and you think, well, that person's wealthy because of the car they have. I mean, this is all payments for most part. People that are prudent people, in the study that was done in The Millionaire Next Door, you don't even know that the person's a millionaire, okay? Not that they walk around like Hetty Green, the witch of Wall Street, eating oatmeal 3 times a day and wearing the same dress for 30 years. I'm not talking about that. I'm talking about live a modest lifestyle. As their income goes up, as their business increases in value, as over time, what have you, or their returns on their investment, they don't change their living standard. And so they're able to allow their wealth to compound. What people that are wealthy do, they don't have $1,000 monthly car payments. That's just not prudent. And why would you do that? But everybody's different. This is a free world, free economy. And if you want to take on $1,000 a month payment so you can have a F-250 jacked up with all the bells and whistles, King Ranch, whatever, $80,000-$90,000 truck. I mean, I think I saw a sticker on a Grand Wagoneer. It was $100 grand. $100 grand for a Grand Wagoneer. People are paying that, evidently. If you got the money, I guess that's fine. But if 20% of the people with a $1,000 a month plus car payment, that's not wealthy people. That's people that are, well, I got it right now. I got a job. Everything's going good. I mean, their time preference seems to be a little skewed. I don't think it's going to end well. So the Supreme Court, struck down the student loan plan, relief plan that Biden had. So people, were in forbearance. There's like 40 million people that were in have student loans. A lot of them were in forbearance. They weren't making payments because of the pandemic. And I think it got extended like 9 or 10 times. Obviously, it's very popular among these people that have a large majority of people that have student loans. Of course, people, if they can get away with not paying their debts, a lot of people are going to do that. That's just how a lot of people think nowadays. They incur debts and then they don't want to pay. And they have people, it's amazing to me how people rationalize these things. Now, the question is this going to end and payments are going to have to restart, I think, September 1st. And, what's the effect now? I think I saw a Moody's report or some report that something like the average payment is like $300 a month or something like that, a little bit more. And it's like 40 million people, 30 million people. I'm not sure it's going to have a major impact on the economy, but it will for individual people, because $300, if you're making 50 grand, 60 grand a year and $300 a month, that's a big deal for some people. And now that they have to start paying, you're seeing the reactions. It's like, throwing holy water on a vampire. Here's just, this was a tweet I found interesting of some people that, and how they're responding. Now, I'm not saying this is everybody. I'm just saying this is a microcosm, but this is a mindset that some people have. This is not a mindset that gets you ahead in life. This is the wrong mindset. So I just want to use this as an example. You can read the tweets here. It says here, I'm never paying back my student loans. Okay, well, I guarantee you that if you don't pay them, you can't discharge them in bankruptcy. And so your credit rating will be ruined. Okay. And the way that this economy is currently set up is that the banks and the people that lobby the Congress for laws, if everybody says, we'll just go on strike and not pay our thing. They'll just deduct it from your tax returns, or they'll go after your bank accounts or whatever. Okay. Why put yourself in that situation? The problem is you made bad decisions. You didn't understand the world you lived in, and you made bad decisions, and now you have to pay. And there's not going to, at least to this election cycle, it doesn't look like you're going to. And of course, it's the Supreme Court's fault. It's not the fault that you listened to people that didn't know what they were talking about, people that didn't really understand how the world had shifted, people that thought, well, my entry into corporate America is to get a 4-year degree in anything, and then I can get a job. Okay. And there you go. But you didn't get a job in a craft or trade that people want to pay for. Again, all the people that I know that are engineers, credentialed engineers, professional engineers, engineers in training, they have no problem getting jobs. Okay. Let's go on here. It says, I don't know who is going to forgive my loans, but someone's gotta because I'm not effing paying them. LOL. Okay. Is this the kind of people you really want to hire in your business? Do they sound responsible to you? Here's the next person. I'm not paying my loans. That's their problem. If they want the money, then they can just get it from their war crime budget. Okay, well, you got the education, you signed a contract, you agreed to it, and now you want to, you got short sheeted by a lying politician. You thought that this politician was going to alleviate a pain point in your life, and they didn't. When are people going to figure out that you cannot put your trust in politicians? They lie all the time, but you voted for them based on that, and then they didn't deliver. But they don't care because they're in office. This idea that I'm going to go in and vote for a senator, congressman, or president, and somehow they're going to magically come down and kiss my life is beyond naive. It's just dumb to think that way. Here's the next one. College was a means to an end for me. Yeah, see, this is what I'm talking about. They thought this was their entry into the workforce. I needed my degrees to participate in the workforce and increase my salary. I'm not paying these loans back. Nelnet going to have to take that L. Okay. Well, Nelnet's a company that does student loan servicing. Uh, it's a it's actually a company that I have on my watch list. It's a pretty good company, actually. I think it's based in Nebraska. It's kind of got, anyways, not going to get into that. But this is the mentality of America, of a large portion of people in America. I can do what I want. I get what, I mean, this person even said it. They knew that they thought in their mind getting a college degree, who knows what the degree's in. They said they needed to participate in the workforce, which is not true. It's totally not true. And increase their salary, which is not true. Okay, for everyone, it's because you wanted a certain job in a certain field, and did you understand whether or not the cost? Did you do a cost benefit analysis? Did you do the calculations? No, you just signed because everybody says you got to go to college. Your guidance counselors push you into it, parents, the whole thing, because for 40 years that worked, right? That doesn't work anymore. And so now when it doesn't work, it's busted. It's a busted tool. It's a busted plan that doesn't necessarily work for most people. Then I'm not paying. Okay, well, we'll see. So I wanted to get to this. Airline passengers set a record on the 4th of July, actually the day before the 4th of July. It says TSA says its security checkpoints nationwide screened 2.885 million passengers on Friday, topping a previous one-day travel record of 2.883 million on the Sunday after Thanksgiving of 2019. You will recall that is right before the pandemic. This is the highest number of passengers the agency has screened on record. Total number of daily flyers drifted back down to 2.5 on Sunday, but that was still above comparable 2019 levels, the TSA data shows. U.S. air travel this year has been stronger than 2022, but was struggling to consistently top pre-pandemic levels. So Friday's all-time record may signal a much more robust rebound is starting to emerge. So we'll see how that goes. It's one facet of travel. You're seeing that not just here in the U.S., but around the world. I've been pointing that out. It's just another demand recovery and demand for oil. You'll note that it looks like we're going to have some kind of rally in the oil price. A lot of people have been waiting for that. I think a lot of people were short based on this recession call that a lot of people had, and that may be reversing. We had a pretty violent move in some of the oil field services stocks last week, especially offshore, which, if you're a follower of this channel and a subscriber to the Actionable Intelligence Alert newsletter, has been a major theme for us for a couple of years now. We were understanding that the oil field services, particularly offshore, was going to recover after probably the greatest economic depression they had went through. So I did see, for example, an article the other day where one of the consultant companies around oil was saying, well, this recovery in drilling is, the spending won't be as high, or the spending never really went down, or whatever. The thesis I have is very simple. The there was such a depression in the oil field services companies. I'm talking about many bankrupt. A lot of equipment was cold stacked or mothballed. It's no longer useful anymore. It cannot be revived, or it's not economic to revive it. And so, as Bob Rabati said in the Kedem web conference call webcast we had the other day, it's kind of like a real estate issue, right? You have a demand for real estate, boats, rigs, things like that, but there's no more real estate being built. And there's not going to be for a long time. And we've talked about that in the past. So that's why we're so bullish. So we don't need spending to go off the hook, crazy. We just need increases in spending a little bit, which is happening, even single digit or low double digits, like 6 to 10%, and it's going to have a tremendous effect. Why? Because you just don't have the rigs. You just don't have the equipment. I actually have another slide coming up. Let me see if I can just go to that now and show that slide. Yeah, here it is. Here's these from Morgan Stanley. This is around the world, different areas for floater utilization and day rate snapshot. And you could let's just go a tour around the world. U.S. Gulf of Mexico, there's a marketed supply of rigs is 22 and 21 are, being used. That's 95% utilization. When you have day rates between 180 and 474,000, but you'll note, a lot of these are legacy rates. The low end's legacy. So as these things roll off, one job or one contract, they're going to be reset at a higher level. Brazil, they have a marketed supply of 25 rigs, current demand 24. That's a 96% utilization rate. Africa is 19 rigs supplied, current demand 19. It's 100% utilization. So you're seeing day rates between 300 and 500,000. Same thing in Western Europe, 96% utilization. Worldwide, you basically have 86. You do have weakness in Asia Pacific, but these other places are sucking in rigs. I will note that they had these harsh environment rigs off in Norway. There was 2 or 3 rigs, I believe, that came off contract, and there wasn't a market for them. So I think at least 2 of them were moved to the Gulf of Mexico. And now Norway, companies in Norway have come out and said, well, we need these rigs back because companies that want to increase these, increase the production or exploration. So you have this, when you have utilization rates for this equipment at 90% or and above, or even 80% and above, it's a tremendously bullish for rates. Rates are going to go up. And, when you're in like West Africa, you have 100% utilization, then, you're going to have to tow a rig there from somewhere else, or you're going to have to outbid somebody when these things come off. And another thing we're starting to see is, the reason why we're seeing more and more of the larger international oil companies and state-owned oil companies now making final investment decisions for long lead time projects, 2, 3, 4, 5 years out. Why? Because they understand that as shale opportunities in shale, which is short cycle. I mean, as soon as prices go up $10 a barrel, I mean, people go out and start drilling again in these shale basins. Okay. But I think, as we've pointed out before in the research from like Goring and Rosenzweig, for example, that shale is beginning to get near the peak. It's peaked in the Eagle Ford and Bakken and looks to be coming near a peak in the Permian. As those things peak out, the oil supply has to come from somewhere. And there has been, again, there's plenty of oil out there. They know where a lot of the oil is. They just need to go out and develop it. And that takes a long time. And people were reticent to do that in the past few years. That's now changing as we see more and more longer term deals. And you see a basin like Guyana, or what might be developing offshore Namibia, or even projects in the Gulf of Mexico that they work at $40 and below on an oil price that gives the majors a view that we can take this risk on. And I think that they look at the same things that we do, is that over the next 3 to 5 years, what do you anticipate the oil price to be? Okay, is it going to go back to $20 a barrel and stay there, $30 a barrel? Or are we looking at, 60, 70, 80, $90 a barrel? I don't know what their assumptions are, but what we have heard is that the assumptions are much higher. Okay, and that's allowing them to recycle their cash flow and be more confident in making these longer term investments. And of course, the equipment's there. The equipment, like I said, the industry atrophied. And as Bob Rabati said, there's just not enough real estate available. And, so the counter argument would be, well, they're just going to build more rigs and more service boats. Well, not necessarily. I think if rates get to, we're definitely going to go through on rigs, offshore rigs over $500,000 a day, probably 600,000. Maybe we get to, even higher, 700,000. I don't know what it'll peak at. Obviously over time, if the cash flows are just pouring in, a lot of these companies, but there's, somebody eventually is going to say, okay, well, this makes sense for me to build a rig, but how much does it cost to build a drill ship? Okay, $1 billion. You're going to have to pay a lot of that money up front because the yards are not going to be in a mood to finance them. At least they're not now. And so I think the threshold to building more supply of these rigs, as Bob Rabati pointed out in that webcast, that conference call, the appetite to do this, you have to think about, well, I'm going to build a 20 or 25 year asset. What's going to be the return on this asset? Am I going to be able to recover my capital investment and then make a profit, or is it better just to do like one of the offshore service boat companies is doing, is got itself pretty much debt free and is out there slowly but surely buying up competitors and making these acquisitions. And so I'm very bullish on offshore oil services. We have probably a decent amount of them in the portfolio. We have had for a while. There was a time when they weren't really doing anything. This is typical of what we do. We're usually early to these ideas. We have to sit and wait. But like on Friday, these things exploded to the upside. They were across the board. You saw like OIH was up pretty good. You had pretty big spikes in oil field services stocks. And so we'll see what happens with the oil price over the summer. We were kind of waiting to see what happened on that. Again, this is a period of when demand increases in the summer. We've already pointed out that the service sector is, chugging along. People are out on summer vacations. The people are traveling, as we saw from the airline data, as we've seen from the increase in employment in hospitality, lodging, things like this. So we'll see how it goes. But so far, I feel pretty good about, kind of pivoting away from directly from some of the oil producers to more of the oil field services, in particular, offshore oil field services. So that's where we're at on this. So I wanted to point this out because this kind of segues into another theme that we just introduced into the Actionable Intelligence Alert newsletter portfolio. It says here, Argentina mining exploration hits decade high in 2022. Investments in mining exploration in Argentina hit $370 million last year, the highest level in a decade, the country's mining secretariat said on Thursday. Exploratory budgets grew 68% from 2021. That's pretty significant. The Secretariat added in a statement based on data from Standard & Poor's. By 2025, mining exports in Argentina are expected to more than double in size to some $8.6 billion. The Latin American nation, and the region's third largest economy, has a total of 161 mining projects underway. Of those, 24 are in production, with 21 mainly mining for gold and 3 mining silver. So a couple things here. When you mention Argentina, people will be like, well, this place is a basket case. This is what I do, right? I have a spreadsheet where I put basket cases, blown up economies, blown up companies, industries, and I watch them. I have places like North Korea, Venezuela, Myanmar, places like that. I have industries, on here on my list that I am watching to see if they turn around. Maybe small positions in, i.e., crypto mining, for example. But Argentina was on the list. I actually held some shares in a couple companies, small positions, and one in agriculture, one in oil. But I was apprised of a situation that I wasn't paying attention to in Argentina that was brought to my attention that I believe is going to make a major inflection. It's going to be I think, a situation. One of my themes, the situation is, the theme ties into a theme of mine, which is a country or a company or something of that nature going from bad to less bad. And so Argentina is a basket case. They have over 100% inflation. They have multiple debt defaults. They have currency devaluations. They have all kinds of rules and regulations and status type policies. You know the drill. But you will remember, or you may not remember, that they had an election in Argentina in 2015, and a pro-market candidate was elected. Now, in the run-up to that election and subsequent to his election, for example, the Argentina ETF was up like 150% over the 18 months to 2 years after that election of that pro-market candidate. Now, that candidate, that president, he wasn't able to make most of the reforms that he wanted to do. So eventually, after his first term, he was ousted by the legacy and institutional Peronist Kirchner government there. But what we've seen is we're having another election this year in Argentina. And if you look at the polling, if you look at what's happening there, they are going to have a primary election in August. I think it's August 15th. And right now, if you look at the polling, the opposition center-right candidates, there's two candidates from there. There's a candidate that's a really libertarian candidate. So what you're seeing basically is people are tired of the status quo. And so what's more than likely going to happen is we're going to see a pro-market, at least depending on this, we don't know how pro-market, but pretty pro-market candidate and possibly parliamentary election, which follows after that, to the presidential election, candidates that have a pro-market view. And so I have taken a position because if that happens, and the polling's showing that right now, that could create a situation in Argentina, a change in perception. And we're already seeing that the stocks are already moving higher. They have been moving higher. The Argentina ETF is already up pretty substantially, but I think there's a lot more to go. Now, that doesn't mean that Argentina is going to get fixed just because they have one election. The place is a basket case. It has, it's a similar situation where you have a very large constituency of people that like state handouts, that like status policies. And so it's not going to be the next Singapore in the next couple of years. But again, as we've stated before, and as we have demonstrated before in Cyprus and in Pakistan and in Brazil at least once, when things go from less bad or from bad to less bad, that can lead to a tremendous return in the short to medium term in the securities in that particular country. And so we've seen this before. And so that's why I've taken a position in various Argentinian stocks, which trade on the NYSE. There's a decent selection. Now, somebody would say, well, just buy the Argentina ETF. Well, you could do that, but I don't like it because of the constituents of the ETF. It has companies in there from other South American countries. It has banks in there. I don't want that. I want industrial companies. I want the companies I bought are, like I said, that I already had a position in an oil company, an agricultural firm, but then a building supply company, a couple of utilities, things like that. And so we'll see how that happens. This should play out over the next month, 1 to 3 months. I watched the polling. We wrote a big article. I wrote a big article about it in the July issue of the Actionable Intelligence Alert newsletter. But I think, Argentina has a lot of possibilities. And this was, this is particular slide. This news is happening in the context of the basket case nature of the country. Why? Because the world's short of commodities and resources. And so Argentina has tremendous lithium resources. It's underexplored, it's underdeveloped. They have, for example, probably one of the largest, most prospective shale basins, shale oil and gas basins in the world. It's the Vaca Muerta, dead cow fields, right? And the state company is, producing about 4-5, something like 6, I think 600,000 barrels a day come out of that field. And there's, if you get a pro-market government that's going to, reverse policies. We saw what happened in Uzbekistan. You had a statist Soviet legacy government. The post-Soviet president died. He was a apparatchik from Soviet times. He died. His adjuvant took over. He realized that wasn't going to work. They've opened up the economy. They've made reforms, and capital's pouring in, and we've had a tremendous return there in Uzbekistan. So I think something similar can happen, at least as a trade in the short term. And then, what I said in the newsletter was very simply, we'll play this for the trade based on what happens with the near term, with expectations in the election. If we do see a center right or even this libertarian candidate win, I think that you will have a tremendous run in the stocks based on the polling as we get closer to the elections. And from there, we can then evaluate if we want to stick around, if we see reforms happening, if we see capital start coming in. This Vaca Muerta shale could very easily go to 1 million barrels a day, but they're starved for capital down there. They're starved for expertise down there. No one's going to go to these places. It's difficult to work in an environment of 100% inflation. It's difficult to work when the state's sticking their nose in everything. I mean, just for an example, the libertarian candidate, which he's been dropping in the polling, but he's still significant. I think 18 to 20%. He said he would privatize the rest of the state oil company and dollarize the economy, get rid of the central bank. Now, those are pretty radical, but at least that's moving the Overton window, right? And I think this may be a situation where the wheels have fallen off and we go from terrible and bad to less bad and terrible. And like I said before, and we've demonstrated before in the newsletter, that can result in a pretty significant gain. Again, these stocks have already moved a little bit, but I think there's, a lot more for them to run, at least into the short and midterm, into the end of the year. You could, at least through the election in October. And if the candidates that are pro-market come into power, then it may be a sell the news event, and then we reevaluate and see if the reforms are actually going to take hold, or if there's going to be a legacy amount of status that are going to obstruct the changes that are necessary for a long-term positive view on the country. All right, enough on that. Already talked about this. So again, more positive uranium and nuclear news. I mean, it's unbelievable. Every week we're getting more and more positive news. I mean, for a while there, nothing was happening for a year. People were bored. Uranium sucks. The whole, what you get, I'm moving on to the next shiny object. You guys don't know what you're talking about. I bought at the top and lost half my money. You guys are terrible. That kind of stuff. Now, I mean, I just sat there and told people we're in a bull market. Just sit back, hold what you got, buy on dips, because you're in a bull market, and we're just seeing complete zeitgeist change in views towards nuclear power. I mean, just in the last 3 to 6 months, it's major changes in evolution and thinking towards nuclear power. Not just in the US, but Europe, all over the world. It's just one thing after another that's been positive. And here's one of the, are some of these things going to have an immediate impact? No, but it's the change in perception again. that I'm looking at. And the long-term demand that ensues. Here's some of the news for this week. Ontario starts pre-development work for new large-scale nuclear plant. Ontario is looking to build the first large-scale nuclear plant in more than 30 years in order to meet the province's growing electricity demands. Energy Minister Todd Smith announced on Wednesday that the government is looking at a new plant to generate up to 4,800 megawatts, enough to power 4.8 million homes on the site of Bruce Power's current generating station on the shore of Lake Huron. So Bruce Power is already this very large nuclear plant complex in Ontario. And so the idea is, okay, let's build some more plants there. Okay, I'm all for it. It says, right now, it says they have the world's largest operating nuclear facility here right now with about 6,500 megawatts, providing clean, reliable, emissions-free power to the grid, base load power. Yes, let's do it. So again, you know, and this makes sense, right? Because you're not going to build, thousands of solar farms in Canada. It's not going to work. They're too high up on latitude, northern latitudes for solar to work. And so if you want to get rid, for base load power, if you want to get rid of the coal, if you want to get rid of the natural gas, you have to go nuclear. And so this is tremendous. This is first new plants in 30 years. Okay. Who would have thought even 3 months ago, 6 months ago, a year ago? Okay. So this is, again, you pile this on top of the other previous news. We talked about it last week. The Belgians have they're going to reverse the closure of two plants that they said earlier, like around a year ago, that they were going to close. Now they're going to keep them running or reopen them. And so what do we hear from the Netherlands or Michigan? So Michigan is lawmakers have advanced the next state budget, which includes funding to restart the Palisades nuclear power plant that was closed last year. Restart of Palisades would be a first in U.S. history. So again, physics over politics. It's starting to sink into people's heads. We're not going to power a modern industrial technological society with intermittent power. We have to have a certain amount of base load. And if we want to get rid of coal, if we want to get rid of natural gas, then that means we have to go to nuclear power. And so again, this would be the first in U.S. history, right? So again, a year ago or 18 months ago, we were talking about plants that were closing and everybody was despondent. And now we're seeing in Canada talk about building new plants. The Vodal plants are coming online in for Southern Company in Georgia. And, we have more and more positive news. And I stick to my prediction. Eventually, the political situation in Germany will change and they will turn their reactors back on. I predict that will happen. I don't know the time frame, but I am going on record saying that will happen. You're not going to have a choice, okay? You saw what's happening with, if you want to get rid of the Russian gas, it's either that or burn more coal. I mean, again, the sentiment towards rebuildables is not there. People don't want any more of this. They don't want the pollution. They don't want the eyesores. They realize that it's not going to work. And policymakers are starting to realize that now. We had the situation in Sweden last week, we reported, where they said we want to get rid of 100% off of fossil fuels, but the new government, which is a center-right government, threw out the idea about renewables because it's not going to work because the physics don't work. And so what did they say? We have to revive the nuclear program. So the Netherlands is now looking to build 2 new nuclear plants. Again, a lot of these things aren't built yet, but again, it's the mindset shift, the zeitgeist, the public opinion, the perception is changing, okay, and becoming, and all of this is happening at once. It makes you wonder if it's coordinated. I don't know. I'm not going to get into that, but something's happening here. And the problem is that there's not enough fuel for everybody. For example, if you turn that Palisades plant back on, that was never anticipated by those fuel buyers. They stopped buying fuel, they decommissioned, so they have to go out and find fuel now. Well, we know that when, I think it was Diablo Canyon or something, it was a recent plant that put out that was going to shut down, but decided that it wasn't going to shut down then. And so they had to go out and put an RFP for fuel, and they can't get They can't get the order filled. Okay. So again, it's not like there's a shortage of uranium in the Earth's crust. There isn't. But again, the lack of investment, the underinvestment, it will take years to catch up. Okay. And you're starting to add more and more demand now. And of course, the new builds in Asia and in India and these other places, it hasn't stopped. It's actually accelerated. And so the pressure on the industry to produce more fuel, more product is there. And still you have politicians, like in the US, for example, pressuring the Congress to, sanction Russian uranium. That could, that'd be like throwing gasoline on a bonfire. So a lot of things are positively happening in uranium. So again, we're in a bull market. I'm very, very well positioned, have been. I don't have really much to say about it, except you're in a bull market, buy on dips. So I wanted to point this out. China hits back in the chip war, imposing export curbs on crucial raw materials. You know that, for some reason, I don't want to get into it. I don't even want to speculate. We're running around, having this hegemon battle with China, evidently, and, we have restricted certain chips for export, trying to hold them back from developing their chip industry, what have you. Part of the problem here is that, China is able to retaliate. So again, because the United States financializes, it's a long story, financializes the economy, doesn't have any long-term planning because of the way our political system's set up, doesn't recognize national security issues, doesn't have an energy plan, doesn't have an industrial plan, doesn't have any type of plan for anything, which is fine. I'm against government planning, but if you're not going to let the free market solve these problems, and the government's going to install themselves and not, financialize the economy and ignore, the real economy, this is what happens. So, for example, China now is going to impose export controls on two rare elements essential for manufacturing semiconductors. Gallium and germanium will be subject to export controls starting August 1st, quote, to protect national security and interests, unquote. Gallium and germanium are used in a variety of products, including computer chips and solar panels, both on the European Union's list of critical raw materials, which are deemed, quote, crucial to Europe's economy, unquote. The problem is the West doesn't manufacture any of these things. Okay, these particular things are like 95% plus supplied by China. So I don't think a lot of thought goes into, well, we're going to, I don't even know all of the stuff. I haven't done enough research onto it, but I do know just from reading some articles that even specific components that go into like some of our weapon systems are supplied by China. This is ridiculous. Raw materials for pharmaceuticals, and a lot of pharmaceuticals are supplied by China. I mean, we've just completely offshored and we've just let our manufacturing do that. We've let companies do that, right? Because we financialized our economy, because it's all about the next quarter results, and I need to get my costs down. Okay, so that I can get, as my management, I'm incentivized as a management team to get costs down, get profits up, so that I can get my stock options exercised. This is why I came to this company, not to build a company, not to be an owner operator, not to look out for the greater good, okay, stakeholders and things like this. But I come on board as a CEO. You've incentivized me with a large salary, plus this idea that if I get the stock price up to a certain point, I get this many stock options and I become, a multimillionaire, centimillionaire, whatever. And so I'm incentivized. So the incentives, as Charlie Munger said, show me the incentives and I'll tell you the outcome. And so we've offshored, we financialized the economy, and now we have reliance on China and other places for a lot of these raw materials that we need for our industries. And then yet we're still running around, again, this schizophrenic foreign policy that we're talking about, for telling the Pentagon, and the Pentagon telling people in the armed services to prepare for a war with China in 2025. Yet we need raw materials from them for certain components of our military industrial complex. Does that make any sense to anyone? I'm not going to get into it. This is stupid. The United States is on its way to becoming a failed state. Again, we have a schizophrenic foreign policy. We have schizophrenic laws. We need to just get the government out of these things, okay? And another example we talked about before, nuclear power. 20% of the United States' electrical production comes from uranium, and we don't mine any uranium here in this United States. We have tremendous, 40 years ago, I think the United States was the largest producer of uranium. We do have some enrichment capability here, but it's antiquated and it needs to be, and there is a lot of investment coming into it now, but it takes time. How did we let it get like that? We have, an entire part of our nuclear triad, our ballistic submarine fleet is nuclear powered, yet we don't produce any uranium here. That's insanity. Okay. And so eventually this stuff's going to jump up and bite us in the butt. I don't know when, but why are you constantly picking fight? Why not find win-win deals? If you're going to offshore everything, then you certainly can't be antagonizing your suppliers. It's crazy. So, we'll see what happens over time if this actually has an effect. But again, we go back to rare earths also. The reason why we don't do a lot of these things is because here in the United States is because it's very, very dirty. Okay, like rare earths processing, you have all kinds of issues when you process or to get these rare earth materials. That's why it's fine to keep it out of eyesight. Hear no evil, see no evil. It's in China, it's over there somewhere. As long as we get what we need, who cares? And so, when you try to do it here, you're going to get mobbed with so many regulations and so many activists and so many court cases. It makes it very difficult to do anything. Do I think that these things can be done in a safe manner so that the environment's not polluted? Yes, but it's going to cost a lot of money, and that's the problem. Nobody wants to pay the true cost. Okay, they just want to get it from China, where they just dump the stuff into a pit in the back of the plant, and who cares, right? If it seeps into the local water supply or goes into a river. So, we have to make a decision as a country what we're going to do here, what's important to us, and what we're going to tolerate not. We have tremendous resources here, and so do a lot of our allies. And if we're not going to do the stuff here, then we certainly can't be going around the world, bullying everybody. It's not going to work anymore. It doesn't work. And so last but not least, the dark side of solar energy. Again, I have some investments in solar energy on some startups that do community solar and things like that. I think in some places it has a benefit. But one of the things that's not being discussed is, what do you do with this stuff at the end of its life cycle? We saw the same thing with these wind turbine blades. And the problem is people just say, well, they'll just recycle them, John. What's the big deal? Well, who's recycling them? That's the problem. Okay. The amount, it's not worth it to recycle them. It's not like a beer can. Okay. Like when you were a kid, you went around and picked up pop cans and stuff. They had value. This stuff doesn't, because the mineral content is so dispersed in it. It's not worthwhile. It's mostly glass. And it's not worthwhile to recover. So it says here, in the U.S., home installations of solar panels have fully rebounded from the COVID slump, with analysts predicting more than 19 gigawatts of total capacity installed, compared to 13 gigawatts at the close of 2019. The International Renewable Energy Agency official projections assert that large amounts of annual waste are anticipated by the early 1930s. That's exactly right, because these things are rebuildables. They don't last forever. Then they have a useful life, and then you have to do something with them. And could total 78 million tons by the year 2050. 78 million tons. That's a staggering amount. The industry's current circular capacity is woefully unprepared for the deluge of waste that is likely to come. The financial incentive to invest in recycling has never been very strong in solar. With the current capacity, it costs an estimated $20 to $30 to recycle one panel. Sending that same panel to a landfill would cost a mere $1 to $2. So you see, show me the incentives and I'll tell you the outcome. What should happen is, why don't we say this? If you're going to put solar panels up, then you have to post a bond for the recycling of the panels. Okay. And if it's $20 to $30 a panel, you won't have the kind of growth. See, that's the problem. You won't have the kind of growth that you're seeing right now. People won't invest because it won't be cost competitive. you have to, all cost has to be involved in this. And so, if you build an offshore rig in the Gulf of Mexico, you have to post a bond for capping it and dealing with the platform after the useful life of the well. And what happens with a lot of companies, they go bankrupt and then other people get stuck paying it, like the government. Okay. 78 million tons of waste going into landfills isn't going to really work, I don't think, for the world. But eventually this is going to be, again, another limiting factor. The intermittency, the lack of resources to do even one cycle of this transition, the waste involved, all these things are conspiring against an eventual, this idea that you're going to run the world off renewables. Okay, again, they have their place in some applications, but you're not going to, I just don't see the ability to do this. And if you put the full cost on the consumer okay, you want to put panels on your house. Okay, there's 40, 50, 60 panels up there. What's the inflation adjusted cost to recycle it, in 20, 25 years once they have to be replaced? And if you have to put that in as the potential cost now, it won't happen. And so I think that's eventually what's going to happen, because as the waste streams increase, people, all of a sudden the light bulb will go off. I saw it when I was I did a repower of a wind farm in Illinois. And we had a major problem because when we demoed the towers, there is a lot of useful recycling. You can recycle the steel in the towers, the copper in the generators. There's certain metal components in copper that can be recycled. The nacelle, the things like that are made out of fiberglass, and the blades, we basically chopped them up with this big bandsaw, mobile bandsaw, and then started taking them to the landfill. And then the landfill operator was like, wait a minute, what are you doing here? Where is this stuff coming from, and what are you bringing here? And there was this waste stream of cut up blades, and they didn't want them. They said, listen, our landfill space is limited. The ability to get these landfills permitted is limited, and we don't want to take on this waste that is going to take 1 million years to decompose in the landfill. This is crazy. And so we saw that pushback. The problem got solved. We eventually found some place to take them. But again, everybody talks about this recycling. It can be done, but there's a cost to it. And I think that, a whole cottage industry, if you put the cost on the person that's putting the panels in, the manufacturers, the end users, then a recycling industry will develop, and obviously it'll get more efficient and costs will come down, I'm sure. But we're not doing anything. We're just saying we'll just chuck them in the landfill. And until we get, nanotechnology to the point where we can disassemble things at the molecular level or atomic level, then throwing them in a landfill probably isn't going to work long term. So we'll see how this develops. Again, this is another reason why nuclear, I think, is going to end up being, you're seeing the shift to nuclear. It just makes sense, even on the waste streams. I mean, the canard, that nuclear waste, I mean, you can research it, and if you don't understand after you look at it how minimal the waste actually is and how it can be easily dealt with, then you're just either an ideologue or dumb. And but this isn't going to work. 78 million tons in landfills isn't going to work. So we'll see how this plays out. Again, I think these things have their place in certain applications, but rolling them out and thinking you're going to have a transition to this, again, you don't even have the resources to do one full cycle. Okay, you can't even do one full cycle. So eventually that realization is going to hit, and that's what kind of, is the whole basis of the view of the heads we win, tails we win more thesis that we have for this resource bull market over this decade, probably longer than this decade. So we'll see. All right, that's it for this week, guys. Appreciate the support and viewership, and we'll talk to you next week.